How's it going, guys, and welcome back to the Blockware Intelligence YouTube channel. My name is Blake Davis, and we are back for episode 10 of Crypto Equity Investing 101. This episode is going to be a follow-up to my previous price patterns video. Instead, in this one, we're going to go a little bit more in depth into some more advanced patterns and trading patterns that we can use that are beyond just the basics of the cup and handle and the double bottom, the things that I shared last time. So as always, please remember that none of the information in this series is investment advice. I am not a certified financial advisor, and nobody should pursue any investment strategy without conducting proper due diligence. So to start us off, I'm going to talk about a relatively common pattern that we see, and this is called 3 weeks tight. So 3 weeks tight occurs when you have 2 consecutive weeks of tight weekly closes to that first initial week. So it creates 3 consecutive weeks of close and tight closing prices. Generally speaking, I use 1.5% as that bar for whether or not I consider it a tight weekly close or not. And ideally, we would like to see 3 weeks tight on light volume. So 3 weeks tight, we kind of use it to look at institutional behavior. So what we're looking at is when you see 3 weeks of tight closing prices and on light volume, that could be a strong signal that institutions are holding on to positions and they're not dumping their position once a consolidation begins. So really, 3 weeks tight is a sign of institutional conviction. Next, I'm going to talk about one of the more rare but most powerful price patterns, and that's the high and tight flag. So for the high and tight flag, we're looking for for the pull. So you can see on that little diagram I've drawn there, the pull is the initial run up. So what we're looking for is anywhere from 80 to 120%, ballpark, something around there. Could be a little less, could be more. But we're looking for a significant run up in price over the course of a few weeks. Generally speaking, we're looking for anywhere from call it 3 to 6 weeks on that pull. So we want it to be relatively short. And then we want that to be followed by a short and shallow consolidation to build this flag. So generally speaking, we want it anywhere from 5 to 25%. What we don't want is a flag that is relatively deep. So once you start to get over 25%, then that flag's a little too deep to be classified as a high and tight flag. But what we're looking for is a significant run up followed by a short consolidation and also ideally on light volume. So here we have an example of a high and tight flag using Qualcomm in the late 90s. And what you can see is this last initial run that Qualcomm had made leading up to that 2000 dot-com bubble when we see this climax top here in early 2000. So what you can see is this is the area we're focused on over here, and what you can see is a 115% gain here over the course of about 5 weeks. So starting here on this week, following this previous red week, going all the way up till we top and form this first red candle here. And then from there, we form this 4-week consolidation to about 19% off that high. And what you can see down here is volume starts to drop off. It's still, relatively high volume, but we do see a slight decline in volume. So this would be classified as a high and tight flag. And then what you can see is you would use the top of this week here as your pivot point. So once price breaks back above that on this week would be a signal to re-enter the stock or maybe add to a position, or you could start a position. But then from there you see this another 100+% gain up until this climax top here in early 2000. So the next pattern we're going to discuss is actually a topping pattern, which is the head and shoulders. So as you can see in that diagram down there below, it's signified by a left shoulder and then a head, which is cuts above that previous high made by the left shoulder, which then sells off. And then you see a slight bounce to create the right shoulder before selling off further. So the head and shoulders is a pretty commonly discussed pattern, but it's actually a lot more rare than people seem to give it credit for. And that's because the head and shoulder actually requires that the right shoulder is lower than the left. So you might see a lot of faulty head and shoulder patterns, and oftentimes they actually break to the upside on occasion, and that's just because it's a faulty pattern and that characteristic of the right shoulder having to be below the left shoulder isn't met. So here we have an example of a head and shoulders top using the S&P 500 going into the Great Recession in 2008. So as you can see, we created the left shoulder here on this initial jump, and then you sell off before retaking that high and making a new all-time high to create that head, which then sells off, bounces again to create that right shoulder, which is below the left shoulder there, as you can see. And then of course we break down below these levels. You could have used maybe this area here as a final stop, as a signal to get out of the market as we create a new lower low. But as you can see, this is a pretty textbook head and shoulders pattern, and I'm using the weekly chart as you should for most patterns. So if, as I talked about in the previous original price patterns video, it's significant to know how long the base is. So using the weekly chart matters, because if it's a relatively short base, maybe that only shows up on the daily chart and isn't clean on the weekly chart, chances are it's not a significant enough amount of time to be classified as a true base. So for all of these charts, I'm using the weekly. So now using similar criteria, but actually the opposite, would be the inverse head and shoulders, which is essentially the opposite of the regular head and shoulders, and instead we use it to signify bottoms. So this is also not as common as people like to think it is, just simply due to the fact that now we need to see that right shoulder undercut that previous support level made by the left shoulder. And that's kind of similar to something we're going to talk about later with the undercut and rally. But a lot of people might have their stop losses placed at the low of that left shoulder. So what institutions will do is they'll undercut that price level to scoop up their shares. So the inverse head and shoulders is a bottoming pattern, just the opposite of the regular head and shoulders. So here we're looking at Apple at the bottom of that 2000 bear market, and Apple actually bottoms relatively early, so in 2001 versus the general market bottoming in 2002, 2003 area. So what you can see is, of course, this would be that left shoulder in the inverse, this would be the head, and then this would be the right shoulder. And it can be kind of hard to tell here, but this weekly candle actually does undercut that support level there made by the left shoulder. And of course, you see we kind of run up here, run into a key moving average here on the weekly before selling off further, but we never undercut that previous low level, so the base is still intact. And this is actually the lowest price that we see Apple at the bottom of that 2000 bear market. So just one more example of a inverse head and shoulders. So the next thing I want to discuss is not necessarily a basing pattern, but it's more of a trading pattern that we see using candlesticks. And it's one of my favorites. It's called the oops reversal. And I was introduced to this by a guy named Richard Moglen, but it is fairly popular to use amongst traders. And the oops reversal is a signal of a mistake made by institutional traders. So essentially what happens is you see price selling down in pre-market below the previous day's low. So you see a gap down to start, to open up the market. And then it reverses intraday to close inside the previous day's range. And that might be a little confusing, so I'm going to show you an example, of course, next, and that will, help to clarify things. But it's a sign of reversal because the shares that were sold pre-market are now being bought back once the stock starts to show some strength intraday. And oftentimes you'll see these come around bottoms because of this reversal that it signals a bottom or a switch in the institutional behavior around price action, at least in the very short term. So what we're looking at here is a chart of Cloudflare. The ticker is NET. And this was on this big run that Cloudflare had made back a couple years ago. And what you see is we're looking at this day right here. So this is the oops reversal. So it can be maybe a little hard to tell, but right here on this horizontal line would be your opening price. And as you can see, we gapped down from the previous day's closing price. So we opened up here down below the previous day's range, right? We're looking even the low of the previous day, which would be right here. We open up below it, and price ends up reversing to close back into the previous day's range, or in this case, we're actually above the previous day's high on our closing price. And as you can see, it was a signal of a potential trend change, and at this point, Cloudflare went on this massive climax run from here. But the oops reversal is relatively common, right? You can see another one right here as well. They happen a fair amount of time, and of course they don't always signal a trend change, but a lot of times they do. So I think it's an interesting thing to keep an eye on, right? You can see another one here. You can see another one here. You can see another one here, right? And in all these occasions, you go on at least a couple day run. So I think it is worth mentioning and worth keeping an eye on. So the last pattern I'm going to discuss is another trading pattern, not a basing pattern, and that is on the undercut and rally, as I alluded to a little bit earlier. And the undercut and rally happens when price undercuts a relatively important support level, but reverses to close higher back above that support level. And as I mentioned earlier, this is a common strategy that institutional traders will use to take out stop losses and then collect shares for relatively cheap. And because a lot of traders will place stop losses slightly below support levels, as they want to be out of their position if that stock is going to break support and continue lower. So a lot of time these institutional traders will sell the stock down just to undercut that price level, and then buy back all those shares for relatively cheap. So oftentimes what you'll see is an undercut and then reversal to close above a support level comes around a bottom, at least in the short term. So here we're looking at an example of Celsius, the drink company. CELH is the ticker. And this is another fairly recent example, but what we can see here is a support level from this earnings gap down. Price is supported around here, and you can see when it retests it a few days later, it holds to go on a short run that ultimately reverses lower. And what you can see here on this day is that price gap down. So this is another oops reversal, but price gaps down below this support zone here that I've highlighted in gray. And then reverses higher once institutions or just traders in general are blowing out stop losses that maybe have placed around that support level, and then you see, of course, it goes on this run following that. So the undercut and rally is another I think fairly common and important trading pattern to understand, and as you can see here, a lot of times they'll go side by side with the oops reversal. So that's just, one more thing to keep an eye on. So that is all I have for you guys today. If you enjoyed this video and are enjoying this series, I would appreciate leaving a like, maybe comment some feedback, and consider subscribing to the channel. But thanks to all of you guys who have stuck around to the end, and thank you all for watching. Be sure to tune in next week for episode 11.